Hello and welcome. It's Tuesday, May the 27th, 2025, and you're tuned in to the 47th edition of Finwell Daily Brief. We've got the latest numbers for you, fresh off the market close at 3:30 p.m. IST.
A very warm welcome to everyone listening. Yes, let's get right into what shaped the markets today.
Absolutely. And you know how we like to start with our financial fact of the day. And this one's quite something. Over 40% of Indian retail investors, maybe even more now, are using systematic investment plans, SIPs, for mutual funds.
That's a huge number.
It is. And get this, last month, April 2025, the monthly SIP inflows, they crossed 20,000 crore for the first time ever. Monumental.
Wow. 20,000 crore in a month.
Exactly. Think about what that says about retail participation. It's a real shift towards disciplined long-term investing, don't you think?
Oh, undoubtedly. It really highlights a growing maturity among retail investors in India, a commitment to planning, not just speculating. It signals a much more resilient investment culture emerging.
I'm going to put it better myself. Okay, let's dig into the market summary now. The Nifty 50, it ended the day at 24,837.70. That's down 163.45 points. Or about 0.65%.
Right. And it looked like IT and financials were the main drags on the index today. Some definite pressure there.
Yeah, they certainly felt some headwinds, but we need to look broader, right?
Exactly. The wider market tells a slightly different story sometimes.
Precisely. So the Nifty Midcap 150 actually finished up, gained 28.70 points. That's 0.14% in the green.
Interesting.
And the Nifty Smallcap 250 also edged higher, adding 14.90 points, about 0.09%. So some buying interest beyond the big names.
Yeah, seems like investors were maybe finding some value or, growth stories in the mid and small cap space.
Makes sense. The Nifty Total Market Index, though, it kind of followed the Nifty 50. Closed at 12,840.45, down 47.95 points, which is 0.37%.
Well, that divergence between the benchmark and the broader market, it often points to maybe sector rotation or, like you said, maybe a bigger appetite for those mid and small caps right now.
Yeah, interesting dynamics. Okay, let's shift to bonds. The 10-year yield ticked up just a bit to 6.22%. What's driving that?
Well, it's a marginal rise, but it seems to reflect a bit of mixed feelings in the market. You see the RBI's surplus transfer to the government, 2.69 lakh crore. It's huge, obviously.
Yeah.
But the market, well, it was hoping for even more. Some estimates were north of 3 lakh crore. So that slightly lower number kind of tempered the immediate optimism.
Ah, okay. Expectations game.
Exactly. But at the same time, there's still this underlying expectation globally and domestically about potential rate cuts down the line. So you've got that push-pull happening.
Right. Balancing the slightly lower surplus with hopes for future easing. Got it. And the rupee. How did our currency do against the U.S. dollar?
Actually pretty strong today. The rupee appreciated to 85.38 against the dollar.
Oh, good to see.
Yeah, it's being supported by fairly consistent foreign inflows, plus the RBI seems to be stepping in when needed. That's quite encouraging, especially with the dollar itself being, a bit choppy lately.
Definitely a positive sign. Okay, let's unpack some of these key points a bit more. That RBI surplus, 2.69 lakh crore. Massive amount, but like you said, below expectations. What are the ripple effects?
Well, the thing is, the market had really built up this expectation of a larger transfer, maybe over 3 lakh crore. The thinking was, more money for the government could mean more spending, maybe a fiscal boost.
Right, a potential stimulus.
Exactly. So the slightly smaller amount, well, it just dials back those immediate expectations a notch. But, and this is important, the hope for RBI rate cuts later this year is still very much alive.
So the bond market hasn't given up hope.
Not at all. Many analysts think if those rate cuts do happen, bond yields could still ease further. So maybe less immediate fireworks, but the potential for a gradual positive trend is still there.
Okay, less immediate boost, but underlying optimism remains. Let's hop over to the U.S., the Federal Reserve. They held rates steady again. What's the thinking there?
Yeah, the Fed's sticking to its cautious stance.
Yeah.
Rates held at that 4.25% to 4.50% range. They're clearly watching inflation very closely, and, those ongoing trade tensions add another layer of uncertainty.
So caution is the word, but what's the market predicting?
Well, despite the Fed's own cautious language, the market consensus is still pricing in likely 3 rate cuts in 2025. Many are betting the first one could even come in July.
3 cuts starting July. That's quite optimistic. And how does that potentially impact India?
It's all about global capital flows, really. If the Fed does start cutting rates, U.S. assets become, relatively speaking, less attractive from a yield perspective.
Right, lower returns there.
Exactly. So that could push more foreign money towards emerging markets like India, where you potentially have higher growth and, better returns. We could see more FPI flows coming our way.
Ah, the hunt for yield effect. Makes sense. Speaking of foreign portfolio investors, FPIs, we've actually seen quite a bit of action from them this month, haven't we?
We certainly have. May has been, well, pretty strong for FPI inflows into Indian equities. The net buying figure is around 14,429 crore.
Wow, that's significant.
It's the highest monthly inflow since September last year, I think. A lot of that was driven by optimism around, potential ceasefires globally, plus some large block deals happening in the market.
Okay, strong month overall, but any recent shifts?
Well, yes. It's worth noting that just in the last week, the trend reversed slightly. We saw net selling by FPIs to the tune of about 4,784 crore.
So maybe some profit taking or just a bit of caution creeping back in.
Could be either or a mix of both. Something to keep an eye on, definitely.
Okay, let's talk precious metals. Gold and silver prices seemed a bit softer today.
Yeah, a slight dip. 24-karat gold in Mumbai was around 97,630 per 10 grams. MCX futures also down a bit, near 96,018. Silver also eased slightly to about 98,094 per kilo.
And what's behind that softness?
Well, one interpretation is that it's linked to slightly easing trade tensions, particularly between the U.S. and the EU. Gold is often seen as a safe haven.
Right, a risk-off asset.
Exactly. So if global economic fears recede even a little bit, the demand for that safety can lessen, putting some downward pressure on prices. Makes sense.
Less worry, less need for gold. Got it. What about oil? Brent crude seemed a bit volatile.
It did. Brent actually climbed up to $65.75 a barrel earlier, but then it pulled back to around $64.90.
So gave back its gains.
Pretty much.
Yeah.
And some analysts are watching key technical levels. They're suggesting that if it can't hold above a certain resistance point, we might see it slide further, maybe even below $61.65.
And why the potential slide?
It seems to be driven by lingering worries about global oil demand, coupled with reports of rising crude inventories. Basic supply and demand, more supply, potentially weaker demand usually means lower prices.
Supply and demand fundamentals at play. Okay, let's shift focus to the primary market. There's an IPO closing this week, Aegis Vopak Terminals. What's the story there?
Yeah, that one's definitely drawing attention. It's a fairly large IPO, aiming to raise 23,800 crore. The price band is 223 to 235 per share, and the subscription closes tomorrow, May 28th.
And how's the interest been so far?
Pretty strong, especially from institutions. On just the second day, the institutional part was already subscribed 1.2 times. That's usually a positive sign.
And the company itself, what do they do?
They're a big player in liquid storage solutions. They have a really strong, almost dominant position in chemical logistics here in India. Plus, their financials look good. They've shown around an 18% compound annual growth rate, CAGR, in revenue.
Wow, strong market position, good growth. Sounds like a compelling story for investors looking at the IPO.
It certainly seems to have the key ingredients that attract investors, yes.
Okay, let's zoom back out. Summing up today's market action and looking ahead, what's your overall take?
Well, synthesizing everything, today felt like a day of selective caution. You had the Nifty 50 down, but mid and small caps showed some resilience. That suggests investors aren't panicking, but they are being choosy.
And the bond market.
Still holding on to that optimism about potential RBI rate cuts, even with the slightly lower surplus transfer. That's providing some underlying support, I think.
And we saw clear sector divergence, too.
Definitely. Auto and metals look strong, helped by specific news like the JSW Steel legal relief and Tata Motors EV plans. But IT and pharma were under pressure, likely reflecting some weak Q4 numbers like Sun Pharma's dip and maybe ongoing margin concerns.
And any other sectors showing signs of life?
Renewables continue to buzz. You've got Vikram Solar lining up an IPO, Oler raising significant funds. Lots of activity suggesting growth there.
So, a mixed bag across sectors. What are the key things for investors to watch now?
Looking ahead, I think two big things stand out. First, obviously what the U.S. Fed does or says next about interest rates. That's crucial for global flows.
Right, the Fed's shadow looms large.
And second, domestically, India's Q4 GDP data. The expectation is around 6.7% growth, which is pretty healthy. Seeing that confirmed would be important for sentiment and for attracting those FPI flows we talked about.
So Fed policy and our own GDP numbers are key drivers for FPIs going forward. Okay, practical advice time. For our retail listeners trying to make sense of all this, what's your suggestion?
I'd say focus on areas that are somewhat insulated from global headwinds and rely more on domestic demand. Think FMCG, think infrastructure-related sectors. Those tend to be more stable when global uncertainty is high.
Makes sense. Play defensive, focus domestic.
And also, maybe be a little cautious with small caps right now. They've had a good run. Some might be looking a bit stretched valuation-wise. They can be more volatile, so just exercise care there. Due diligence is key, as always.
Good, practical advice. Now, before we wrap up the market chat, we need to touch on something really important, a warning about a nasty scam.
Yes, this is crucial. We want everyone to be aware of something called a boiler room scam.
Boiler room. Sounds intense.
It is. Basically, these are fraudulent operations. They use high-pressure tactics, usually cold calling people relentlessly. They push you to buy shares in companies that are often worthless, sometimes completely fake.
How do they make it seem real?
They're very manipulative. They might even artificially inflate the share price for a short time to make it look legitimate and suck more people in. They promise guaranteed returns, create immense urgency. And then, once they've collected enough money, poof, they disappear, vanish, leaving investors holding worthless stock and facing huge losses. It's devastating.
That's truly awful. What are the red flags? How can people protect themselves?
Key red flags. First, unsolicited calls pushing investments. Be immediately skeptical. Second, promises of guaranteed high returns. That's almost always a lie in investing. Third, intense pressure to invest right now.
Don't get rushed.
Exactly. And critically, if they refuse to give you their SEBI registration details, or if you can't verify them independently, that's a massive red flag. Run away.
So always verify how.
Always verify your broker or advisor. Use SEBI's official scores portal. It's there for investor protection. Check their credentials before you even think about investing a single rupee. Your money is hard-earned. Protect it fiercely.
Absolutely crucial advice there. Now listen, if you're finding these daily insights helpful, if FinWell Daily Brief is helping you cut through the noise and understand the market better, then please do us a favor and hit that subscribe button wherever you get your podcasts. It means you won't miss out on your daily dose of essential financial intel, helping you navigate these markets with more confidence. And hey, if you have questions, want to discuss something further, or just connect, find us SOS FinWell on LinkedIn. We genuinely love hearing from you and engaging in the conversation. End of promotional message.
All right, so wrapping up today's session, we saw a bit of a market dip, yes, but it feels more like caution ahead of key U.S. data and Fed signals, rather than panic.
Yeah, and importantly, India's own fundamentals look pretty solid, don't they? The stable rupee, decent FDI, and those incredible SIP numbers we started with, they all provide a good cushion, limit the downside risk.
I agree. The underlying story here remains strong. So for investors, the advice remains: be selective. Focus on quality. Focus on sectors plugged into India's domestic growth, especially those with regulatory tailwinds.
Sound strategy. And let's end with a quote that really resonates in times like these. It's from the legendary investor Peter Lynch. Know what you own and know why you own it.
Simple, powerful, and timeless advice.
Indeed it is. Thanks everyone for joining us on FinWell Daily Brief. We'll be back tomorrow with the next market update. Have a great evening.